This economic outlook is something that we do typically here at the Chamber about 2 times a year. We typically do it kind of towards the first year like a lot of other chambers do. But then we also try to do our best to present a mid-year outlook to kind of give an idea of where the economy is now. And so from the standpoint of many of you for your business planning, hopefully this is something that will be of value, as well as for those of you who just simply want this information. And our goal with this is not only to provide information about the national economy, but to also do some work on what the economy is doing in the state of North Carolina as well as in our local area. And I'm excited because we actually have a new product that we're going to be showcasing for the first time. And that is something that I developed that we actually went out and several businesses participated in this past week. It was kind of a dry run, but we're really excited about it. It's something that we hope to be doing on a pretty regular basis going forward, about really trying to do a better job of assessing local business condition. So to kind of start off with, the good news is that if you're here in Rocky Mount, but also if you go all across the country, you'll see that there is a lot of visible growth. We are still in a growth cycle that started around 2009. Historically, this is a very long growth cycle. Typically, growth cycles last only about 4 or 5 years, and they're typically then offset by a recession, usually lasting a little less than a year. We did go through a very significant and extended recession that even after we got into a growth period, still the impact of that recession was felt long term, especially because the growth that we've seen over the last decade has been perhaps at a lower rate than what we're typically accustomed to. Between 1960 and between 1980 and about 2005, 2006, average growth was a little over 3%. And since then, our growth rate's been more around the 2% area. And that 1% does have a significant impact on wages, it has a significant impact on job growth. But what we are seeing throughout the country, and even here now in Rocky Mountains, we are seeing that growth. And that is not to say that everything is perfect, and there's a lot of volatility out there, as well as the fact that when you look at national statistics, particularly those that have come out in the last couple of weeks, you'll see that they're starting to show some mixed results. And particularly there's been a lot of talk in the media about housing, a lot of talk in the media about some other indications of economic activity. And I would simply say that there's a lot of instability. We know that we're not in that era of tranquility that perhaps we would like to be in from the standpoint of politics and industry. And so that instability that does exist in politics and in the market is having a little bit of an impact on the fact that not all indicators are moving exactly in the right direction. But that's not to say that we are anticipating growth to subside or end in the short term. We're still anticipating growth to continue through 2019 and probably 2020, maybe start seeing some slowdowns in 2021. At some point, growth cycles do come to an end. Nothing lasts forever. However, we do feel that there's no cause for alarm right now. It's just a matter of trying to find, hopefully, some stability. Some of that stability was seen earlier this year. We had a shutdown in Washington, a prolonged shutdown that lasted several weeks. That did have some impact. And one of the things we have to think about here in Rocky Mountains, we're only 4 hours away from Washington, D.C., 4 hours away from the megatropolis now that is known as Northern Virginia. I lived there for a couple of years, and I can tell you it feels like you're living in a totally different world, even when you live in Manassas. And so the reality is that there has been a little bit of a stumble, particularly here in the Mid-Atlantic, because of the influence of being the home to the nation's capital. But that stumble has kind of subsided, and we're starting to now see ourselves pull out of that. The great news for North Carolina is that we are continuing to move on a strong path with respect to economic growth and various indicators that we have to look at on the state level. And I will show you that growth is projected to continue through 2019 and into 2020. And that's also great news because Rocky Mount, the recovery is here. We are really trying to see it. And I know David talks about it a lot. I know a lot of you talk about it. We are seeing recovery here in Rocky Mount. It's been a long time coming. We've been seeing some recovery over the years, but we're really starting to see it now. And some of the statistics I'll show you towards the end really bring that home. Looking at our national trends, and I'll be happy to take questions at the end from people here in the audience as well. Let's first of all talk about GDP. The good news was we actually did see 3% GDP growth in the first quarter, and this is a revised number. When GDP growth is announced, it's typically announced towards the end of the month following the end of the quarter, so it was actually in early May that the first GDP number came out, and then it's revised twice. So the first revision, which took effect at the end of last month and the end of May, it actually went from 3.2 to 3.1%. And that's actually pretty good. And as you can see, We finished off the quarter just a little over 2%. We of course had that 4% in the second quarter of 2018. So we are starting to see some stronger growth in certain periods, but we still have some of those lull periods. The first quarter can sometimes be prescribed as a lull because you're dealing with weather. You're dealing with some other uncertainties that can occur during the first quarter. There's kind of that offset in the holiday season from the standpoint of consumer spending. So there's always that possibility that the first quarter may not necessarily perform as well at an annualized rate as the other quarters. But the fact is, 3% though, given some of the things that we knew were going on with the shutdown and other activities, is a pretty good indicator. Now, the real question is, how do we get about 3% growth? How do you really achieve 3% growth? Because there's a lot of factors involved in this. And I realize this slide may be a little tougher to read, but this slide deck will be made available. I would like to try to get everybody's email address that I can, and I'll also make sure it's posted on the Chamber Facebook page. But what you see here is there were some significant areas that saw very strong growth. Private domestic investment grew 4%, 4.3% in the first quarter. That's a very good sign. Primarily that was due to, we also saw some growth in non-residential construction, 2.3%. We saw 7.2% growth in intellectual property. Intellectual property has only been factored into GDP for about the last 4 or 5 years. It was not something that was always tracked, but it is an important aspect of our national economy, whether it's what the drug manufacturers are doing in Durham, whether it's what's being done in Silicon Valley, whatever you want to call intellectual property, that's really become a critical element of our overall economic activity. And we're seeing that continued growth, which is a very good sign overall. We also saw, the other thing perhaps that had the most significant effect was due to what's been going on with our trade policy, we did see some reduction in imports. We had a 2.5% reduction in imports. And this was kind of like the first quarter where we started to see the impact of some of this trade battle that we have had going on with tariffs and other activities actually start to reduce import activity. Some of that also is due to energy prices. That's the one thing we always got to remember. Even though we produce enough energy now to satisfy our own needs, we still import some of our energy as well as export it. And fuel prices did go down in the first quarter of this year, so that did have an effect on imports as well. But what that did was it actually helped reduce our trade deficits, because with GDP, they actually look at overall net export activity. Total exports actually grew the total value of exports grew 4.8%, with goods growing 6.3%. Again, some manufacturing, but a lot of that's probably going to be due to energy and some other needs. And what that does, from the standpoint of contributing to GDP, which you'll see here, is that net exports actually were about 1/3, or actually about 1/3 of total GDP growth could be tied directly to the fact that we had strong net export activity. What does that mean though for working? Well, the good news is that we continue to see growth in wages. These are percentages month by month, annualized, well, they're annualized by quarter, and you can see that we continue to see growth in wages and personal income. Hourly earnings continue to grow. We're looking at about a little over 3% annual increase in wages. That's been something that we've been concerned about as we've gone through this recovery. If you go back to 2014, you'll see we're only around 2%. And that's been one of the public criticisms, and it's probably led to some political activity about the fact that overall incomes have just not really grown the way people have expected them to. That even though the job market's very strong, we have a lot of openings, we have a lot of demand for employment, wages are not necessarily growing in a way that's consistent with what people have experienced in the past. And we now, in the last year or two, have started to see that. And the good news is we are continuing to see that in the most recent data. Now, to talk a little bit about trade, this chart actually comes from the Bureau of Economic Analysis, and it's looking at our trade deficits. And again, this has been a major political issue over the last several years due to the philosophies and practices and policies of the administration. And what we see here is that overall, you can see the blue line is the monthly trade deficit. And what you will notice is that it has gone down. It peaked in the fall of 2018. And the reason why it peaked was that was right before tariffs started taking effect. And so there was a lot of stockpiling. Businesses and companies started stockpiling inventory into the United States before the tariffs took effect. That was also due to the fact that we had rising energy prices as well. Oil, if you remember at that time, was around $70 per barrel. And it was over $70 per barrel, which is kind of kind of the flashpoint that's become with crude oil has been that once it gets to about $70 to $75 per barrel, then there starts to be a little bit of a concern, because that typically means that gasoline prices may raise to over $3 per gallon. Diesel gets to be around $3.50 a gallon, $3.35 to $3.50 a gallon. And that's when people start worrying about it. And of course, we've been dealing with that now for almost 15 years. But the reality, of course, is that once the tariffs took effect, it did result in a reduction in the trade deficit. Now, that does not mean necessarily that export activity has gone down, though there are some concerns in respect to something of very importance to us here in Eastern North Carolina, and that's agriculture. But the reality has been that, as you can see, we are seeing a reduction in the trade deficit. I had a chance to read a report from UBS, and it talked about, well, what does that really look like? Well, the first thing overall is, even though the trade deficit has gone down, overall trade volume, maybe the value of imports and exports have changed, but overall volume of activity hasn't changed all that much. A lot of it has actually shifted from China to other countries. China, of course, being the main target of the president's trade policies. A lot of that has shifted over. Some products have shifted over to Vietnam. Some technical products have changed over to Thailand and Taiwan, and even Mexico has benefited as well from this. And of course, now Mexico was potentially the potential target of trade threats. That, of course, has subsided in the past week. What that means is, as you can see here, overall imports are actually growing still a little bit, but so are exports. So if we come here to the first quarter of 2019, you'll see overall value, annualized value of imports is around probably around $3.5 trillion, $3.5 trillion in export activity, compared to about probably about $2.6 trillion $3.5 trillion in import activity compared to about $2.6 trillion in export activity. The good news, and of course, as you can see, that gap over the last several years has remained relatively close to one another. So the gap is not growing all that much. There are, of course, conflicting views about really what the trade deficit means. For some people, it's not a big deal, and for other people, it is. I'm not here to try to get into that discussion, but it is something to think about, because generally speaking, if we are importing more, that's usually also, as much as it can be a sign potentially of maybe lost opportunities for domestic market, that's also a sign for economic growth, because it does mean that we do have increased activity. Also, the fact that these numbers are not too volatile is an indication overall that our currency, that the dollar is relatively stable. Not to say that it's perfect, but that the dollar is relatively stable in the current market. However, one of the things that has been of concern of late, and this was the case in May, was the fact that we did see a stumbling in employment growth at a time where typically in the spring and summer we see increased growth due to seasonal employment. And we only saw 75,000 non-farm related payroll jobs added in the month of May. That may have contributed to helping arrange a negotiation with Mexico. That may be some of the reason why you've heard talk about reducing interest rates. Actually, when I've looked at the numbers, and it's very interesting, the real impact was in the construction industry. ADP, payroll company, actually saw a significant reduction in construction-related jobs in the month of May. And that was due to some of the challenges that are currently associated in the building market. There was a drop-off in construction activity. Now, many construction companies are small businesses. You think of roofers, you think of pavers, you think of most construction companies are actually small businesses that subbed into larger companies. So the real concern was when ADP looked at small business employment, they actually saw that small business employment dropped off about 50,000 jobs in the month of May. And again, this is not to say that the number of small businesses dropped. That's important to understand. But what it does say is that it is likely that this kind of blip that we're seeing right now in the construction industry on a national scale, you may be thinking, hey, I've been to Raleigh, they're building like crazy. I'm in Rocky Mount, we're starting to build. We got, as David likes to say, we got steel going up. The reality is that these are national numbers, and there are some signs nationally that there is kind of a slowing down or a cooling off in construction in other various parts of the country. And that could be for a variety of reasons. So the good news still, though, is that total vacancies are at historic highs. I know that there was some information that came out just recently that hiring actually picked up in the month of May, so that's a very good sign. But overall, vacancies are still very strong and are at historic highs. We still have probably almost 7.5 million vacancies currently nationwide. How many vacancies do we currently have in the Rocky Mount area?
I'm not real sure. We know over the next 18 months we'll have 3,500.
Right, so we got 3,500 vacancies between now and the 18 months, including many that are currently vacant currently. But there are a lot of vacancies, and of course, that's been perhaps one of the biggest challenges. It was nice to see the announcement about the RAMP program at Caroline's, at the RAMP East announcement yesterday from Caroline's Gateway Partnership. But the fact of the matter is that we still have an economy where there is still a huge demand for labor. And a lot of this is skilled labor. Not all of it, but a lot of it is in skilled labor. And that's very important because it's an indication that there is still room for the economy to grow. That's the good news. When you start seeing vacancies go down, that's when you have to start worrying a little bit. But this fluctuation here really is not that big of a concern. The fact that we're still at a historic high and that we've sustained that historic high now for over a year is a very good sign for us nationally. What that also means is that wages are also growing up. We talked about this a little bit before, but as you can see, annual wages are now up into the 3% plus range. That's important. This is hourly earnings. This is something that is tracked on a monthly basis by Bureau of Labor Statistics. And as you can see, that's important because really it's that level of growth that allows people to actually start improving their quality of life, potentially investing, paying off debt, really being able to be in a better place with respect to their overall economic health. And what that does also mean is that it helps maintain the continued growth in consumer spending. Now, there are a lot of different factors that contribute to consumer spending, including increased population and other factors. So it's not necessarily fair to simply compare wage growth to spending growth. They're not exactly tied together. You have to watch out a little bit for debt, but generally the debt numbers look okay. But as you can see here, consumer spending continues to be above 4% a year. And that is a very strong sign for us on a national basis. Looking at household debt, because obviously if spending was growing and people were putting it on credit, that would be a short-term gain with long-term consequences. What we actually see overall is that debt levels are relatively manageable. And I went back to the recession because really that's the thing we want to watch out for. Because as we saw, one of the challenges that we had in the recession was the fact that, simply put, a lot of people were over leveraged. I mean, when you factor in household debt and in consumer debt, which are credit cards, car payments and such, and mortgage debt, and you see that you're at 13%, that's a pretty unsustainable level for a lot of people. We are now in the 10% range, which is typically kind of an average, and as you can see, that is still subsiding. And a lot of that has to do with the fact that overall percentage of disposable income with respect to mortgage payments has continued to go down. And I think a lot of that is the fact that part of it is that a lot of people are living in their houses longer than they did in the past, and so they're continuing with the mortgage rates, with their mortgage payments that they had before. As their income goes up, it becomes a smaller percentage of their overall income, so that does help. Consumer debt has gone up a little bit, but it's still not where it was before. And as you can see, that variance is not that much. It stays between 5 and 6%. So we're not seeing it go up significantly. We're not seeing it go down. It seems to be manageable. But overall household debt is about 10%. So that is a good sign. There are some indicators out there that express concern, like with respect to car payments that are outstanding. Those numbers have gone up. I would say a lot of that is just simply the price of automobiles and the nature of the terms of the payments. And that is something that the auto industry really needs to work on. That's more of an industry-specific issue that has to be addressed going forward. Now, one of the other things that we're seeing is we're actually starting to see on a national basis I guess you could say a healthy cooling off of the housing market. This is not a collapse like what we saw in 2008 or 2007, 2008 of the market. This is more of the situation where finally, because of the nature of sale prices, interest rates on mortgages, which have remained relatively low, and also supply, what we're starting to see is, first of all, existing inventories are starting to pick up a little bit, which that was a good sign because they dropped to a relatively low level. We have not had the construction activity in single family housing that we typically had in prior years. And part of that, of course, obviously is one, the recession, but two, a lot of focus was driven towards multifamily development in the post-recession period, particularly in urban areas. But what you see here is that inventory is starting to pick up some, and now we have around a little over 1.8 million units, which overall that's a good sign. It means that the market's getting a little healthier. And what it's also helping to do is it's also helping to cool off the annual rate of growth in housing prices on a national basis. Because again, the challenge with housing is that it's location. If you were to try to look at this from a local perspective, the numbers would be all over the place. There's still markets that are seeing declines, and there's markets that are seeing incredible increases, the triangle being one of them. And so, really, when you're looking at it nationally, you kind of smooth it out, but the good news is, this area, staying in the 4% range, and if it was to stay kind of close between 3 and 4% and stay there for a while, that would not be a bad thing. That would overall be a good thing from the standpoint of the housing market, hopefully enabling more people to take advantage of housing opportunities to try to move into homes. We have a lot of people out there, particularly those in the 25 to 35-year-old category, not going to use the M word, that are looking now to actually buy their first home, and it's a good sign that there's now kind of a more calmer markets. The prices are still maybe not necessarily where they want them to be. There's a lot of demand out there for your $120,000 to $150,000 homes. They're building about a dozen in my neighborhood right now, but it's clear that this is still a better market than where we were before. Home sales overall, however, based on what we saw there was a bit of a dip that we saw in the spring, which is kind of odd because typically it's in the spring that you actually see increased activity. It gets a little warmer, people are buying homes. I will say, and you'll see in the numbers, this was not reflected in Rocky Mount. Rocky Mount saw growth in housing sales in the first quarter of 2019, but we do have to keep in mind, and also the fact is, overall sales continue to move upward. So it's not like this dip in existing sales is a bad thing necessarily. What we're really talking about is that there's a little bit of a dip, but we're not talking about a huge dip. Overall, sometimes when these numbers come out and people see those 1 month swings, they go, uh-oh, there's a problem here. In reality, the market was moving at a pretty aggressive rate, and to be able to kind of slow down a little bit now is probably a good sign. The real question will be, where does it go through the summer and the fall? And really it comes back to housing starts, it comes back to the availability of inventory, because that also plays a role. If there's only so much inventory available, that can affect housing sale volume as well. One of the measures of the economy that's been of very big interest in this post-recovery period has been inflation. In large part because the Federal Reserve has made inflation a real key mission of theirs in terms of their evaluation and management of interest rates. And what they have basically said is they want to try to keep inflation below 2.5%, and it all means by below 3%. And they've been pretty successful, even with the relatively low interest rates that we've had in the pre-recession period, in the post-recession period. And as you can see here, when you look at that core inflation, which is the line in red that takes food and energy out where there's more volatility, you will see that inflation is remaining in a very healthy 2 to 2.5% area. There's not a lot of concern here with respect to inflation right now. Now, that does not necessarily mean that all segments are the same way. We know that there's inflation in healthcare costs, we know there's inflation in housing, we know there's inflation in certain areas, but generally speaking, that has been offset by relative limited cost increases, in some cases cost decreases in other aspects of a consumer shopping basket. Overall, we also are seeing that producer prices are beginning to stabilize a little bit. Producer prices went up significantly in 2017 through late 2018, and a lot of this had to do with commodity prices, some of it having to do with energy as well, but particularly because of a drop down in energy prices and also some other commodities, we've actually seen producer prices remain relatively flat compared to last year, here in the last several months of 2019. And what that means, of course, is, well, what does it all have to do with interest rates? Because interest rates are oftentimes pegged to inflation in terms of that as inflation goes up, interest rates goes up. As inflation goes down, interest rates stabilize. We also have to look at overall how interest rates affect the overall economy. Going into 2019 at the start, the thought was that the Fed would eventually raise rates to about 3%. The thought was, as we start off in January, was that the Federal Reserve would continue to incrementally increase interest rates. If y'all remember, from about 2009 until about 2016, or almost 2016, interest rates were practically at zero. And for those of us who work in institutions where our savings are pretty much pegged based on interest rates, our investment returns are pretty much pegged on that rate and based on treasuries, that was not a really good sign. Saver class was not doing too well. So as a result, we have seen these increases, which has been nice, and we were thinking, well, maybe we'll get up to 3%. But now, and a lot of this is unfortunately political, there does seem to be some cooling off in that projection, and there is even the talk, and some of this has to do with the housing market, and some of it has to do with certain indicators. There has been some talk that there might be a rate reduction. My preference would be that there not be. I try to limit my opinions in these presentations, but the one opinion I will have is that I would hope that that while they may not raise interest rates, my hope is that they will at least keep interest rates at the current level and avoid making any significant reductions. Try to keep it at that level going forward. What's interesting is that regardless of what's been going on with interest rates, mortgage rates have actually declined. Currently, mortgage rates are actually below 4% again for 30-year fixed. So if someone can qualify and someone can find something that they want in the price range they want, now is a good time to go out there and get homes, and that's probably contributed to the housing boom that we've had here locally. We've got some developments that are coming online. We're going to be, for the first time in a very long time, we're going to be seeing some significant housing development over the next 2 to 3 years, both in single family and multifamily, coming forward here in the Rocky Mount area. So what does this mean going forward? Well, there are prognosticators that try to estimate where the economy is going. The two Federal Reserve branches, the Federal Reserve in Atlanta and the Federal Reserve in New York, each do estimates of where they think GDP is going to come in the future quarter. And right now, both of them are anticipating that they definitely believe that GDP's growth in the second quarter is going to be below 2%. They think this is a continuation of some of the issues with trade, as well as some of the issues we've seen with the housing market will contribute to this. So they're anticipating right now, based on the indicators that are out there, that they're anticipating 2%, less than 2% growth for the second quarter of 2019. Now, that's not necessarily meaning that that's going to continue, that lower growth is going to continue in the third quarter. But on a national perspective, they're thinking the Atlanta Fed's estimates are around about 1.5 to 1.4%. This blue chip consensus, that's economic analysts, that's obviously, a lot of that's done by the Wall Street Journal. They're anticipating maybe potentially between 1.5 and 2.5, but they haven't been surveyed since mid-May. And there has been some indicators that might indicate that if they survey them closer to when we'll find out where interest rates, where GDP growth is going to be, and that will be at the end of July for the second quarter, is that we are seeing continued strong confidence in both the consumer sector. University of Michigan does a monthly customer sentiment survey, and it has remained very strong, and it's actually picked up a little bit in the last couple of months. But as you can see, it's close to 100, and in their indication, some like to say it needs to be above 100 or above an index point of 1, but in the Michigan one, typically if it's above 80, that's a good sign. So theirs still remains close to 100. And then the Conference Board's leading economic indicators, where their survey anticipates over the next 6 months, continues to be strong, continues to be at levels that are historically high compared to where they have been in the past. This goes all the way back to the 1990s, and as you can see over the 20-year period, we're at relative highs. And also the coincident indicators, coincident index, which is where we are now, also is moving in the right direction. So generally speaking, those who are being surveyed, those who are seeing what's going on the ground, remain relatively confident about where the economy is headed. However, that does not necessarily mean that while the economy may be moving in the right direction, there might be a concern about the rate of growth more so than whether or not we're going to have growth. Institute for Supply Management does their own composite surveying for manufacturing in the non-manufacturing sector. Overall, the non-manufacturing, which is the service sector, remains generally high. The baseline here is 50, but the manufacturing side has seen some slowdown. And I think a lot of it still has to do with concerns on a national scale with respect to instability and uncertainty. The manufacturing sector wants to see more capital investment. They really have not seen as much of the capital investment that they were expecting as a result of the tax cuts that were passed in 2017. There was a high expectation, and I remember all the way from the day after the election when the economists at Wells Fargo were saying, we expect there to be strong capital growth afterwards. And there really hasn't. There have been a lot of airplanes purchased, but other than that, it's been relatively calm. And I think for a lot of industry, it's still trying to figure out what to do in the modern economy. It's not that they necessarily want to invest, it's a matter of how they want to invest or whether it's the right thing to do at the time. The good news is that small businesses are optimistic. Small business optimism has been very strong since late 2016. There's been a couple of times of dips. You can see that we did have a dip in 2018, but it's still, the baseline has remained above that 100 benchmark pretty much since the 2016 election. Overall, businesses, small businesses, and this is according to NFIB, they do plan to increase employment. There continues to be growth in employment, some in capital, in terms of making capital investments. They do expect the economy to improve. They do expect sales to grow. They do see it as a good opportunity for expansion. There are, of course, some concerns, one being the issue with respect to credit conditions. And of course, that could be due to some tightening in the banking sector. And that's just been a general concern in the small business sector throughout the recovery. But overall, they are in a positive position and continuing to see that growth. And of course, the biggest challenge that many small businesses are having, just like all businesses are having, are with labor. That continues to be a challenge for most small businesses. Talk a little bit about oil and gas. As you can see, the green line is crude oil prices, and as you can, and they're linked over to the table, up to the bars on the left, the axis on the left. And as you can see, in 2018, we saw prices almost reach that $75 mark on crude oil, and that's kind of, that of course drives some, that also has some impact on import and export prices, and obviously has some impact on the economy and producer prices. Dropped all the way down prior to right at Christmas down into the 40s. So there has been volatility in the energy sector. Now we're somewhere in the 50s, which has helped obviously subside gas prices. Here, gas prices are below $2.40 a gallon in many stations. The red line being North Carolina, the blue line being national. There's a broader range of difference during this time because of formulation issues on the West Coast and in some other parts due to summer driving conditions. But the reality being is that gas prices in general, as you can see there, we have not seen gas prices reach about $3 a gallon on a national basis now for several years. That's a very good sign. So we have seen, it still fluctuates. There's still 20, 30, 40% fluctuations. And for those of us who were driving back in the 80s and 90s when we thought that 10 cents was a huge swing in gas prices, there's still fluctuation, but the fact of the matter is we are nowhere near the concerns that we had in the past. $3 seems to be that breaking point on unleaded. Once it gets above 3, particularly in a market like Rocky Mount or North Carolina, people start getting a little concerned. Talk a little bit about stocks. I am not involved in the stock market, so don't come to me ever for stock advice. But just to talk about overall, the S&P has recovered from the slump it started off this year. It's about 4% growth compared to where it started at the beginning of the year. And volatility has started to subside a little bit, as you can see. These volatility indexes are always interesting because typically the more volatility there is, the chances are there's more for a drop in stock prices. And overall, that volatility has subsided some. And hopefully that does mean that the markets are going to remain more stable going forward. Not saying whether or not you're going to necessarily see growth in the market this year, but hopefully there'll be more stability in the market. One area that a lot of people say, a lot of prognosticators like to look at is this concept of Treasury yield curve inversion. This is where, I'm sorry, I didn't do that. Treasury yield curve inversion is where shorter-term treasuries, the maturity rates on shorter-term treasuries actually exceed those of longer-term treasuries. And as you can see, in 2019, we have started seeing where the 30-day treasury actually has a higher maturity than longer-term treasuries. Some people look at this as kind of as an indicator of a pending recession. Generally, however, when I had a chance to listen to an economist at Visa a couple of weeks ago, and he said, if it's sustained and it's significant, there's a possibility. But the reality is they don't anticipate this being sustained. They say it's too early to really tell whether this is going on. But you can see that there's a lot more similarity in the yield curves, in the yields of these treasuries at short and longer terms, which is an indication that people are putting more money into, that there's a higher demand for longer term treasuries than there is for shorter term treasuries. That's an indication that people are concerned about the market. That could be just about what's happened in the market this year. Hopefully, if the market's more stable, those yield curves kind of go back to a more traditional effect. Obviously, treasury yields are a concern to us, not only because of the fact that we have so much national debt being over $20 trillion, so we have to pay the interest on that. We're not paying any principal anytime soon. But also because so much of our debt is financed at short terms. Most of our debt is financed less than 3 years. So obviously we want to make sure that these these yields remain relatively low. If y'all remember what happened in Europe during the recession, where places like Italy and Greece were seeing economic catastrophe, the reason why was they were having to pay 6% on their interest, had to pay 6% interest. If we had to pay 6% interest, the impact it would have on the federal budget, the overall impact it would have on the economy that's tied to government would be considerable. But we should not be going in that direction. We should remain here where we are currently, which is around 2.5%. That is a manageable level. Now that concludes the national part of this. Now let's talk a little bit about regional and state trends. Most of the slides were national, so these slides will be a little less. The good news is that most of this information I'm going to share here comes from the Richmond Fed. They do monthly snapshots and try to compare not just nationally, but also within their district, in which North Carolina is a member, and then as well as looking at it on a state basis. And what you see overall is that our employment is growing ahead of the region. Regionally, employment is growing at about 1.3% year to year. Ours is growing at around 1.6%. Nationally, we're seeing growth at about 1.6 to 1.8 is pretty close to one another. So we continue to grow close to the national average. From the standpoint of where that looks like from an industry perspective, what we are seeing here in North Carolina is that our growth is tied more, of course, to services. We haven't seen as much manufacturing growth here locally, here in the state in the last couple of years. Some of that should change here pretty soon. We just haven't had as many manufacturing openings. We've had some, but not as many as has been seen in other states, including our neighbors to the south. But we have seen growth in logistics, like trade transportation. We've seen a growth in, of course, professional and business services, and we've also seen significant growth in leisure and hospitality. And of course, we also see that here in the Rocky Mountain area. One of the other indicators of economic activity is looking at sales tax collections. And the good news is that what we have seen, sales tax collections are good because, and particularly for North Carolina, because our sales tax base has been relatively broad. So it's a good indicator overall of business activity. And what we see here is that, generally speaking, collections are staying on par with the national average and are actually a little ahead, but they still remain over 5% the year to year is over 5%. And that's a very good sign. So that's an indication that business activity is growing at a pretty consistent and strong rate. Income growth is also doing pretty well. And as you can see, income growth continues to outperform nationally with growth. Both growths are over 3%. I would say ours is probably closer to 3.5%, closer to 4%. Dr. Michael Walden at North Carolina State University provides an index of leading indicators. You can see that there was a little bit of a drop off in the first year, and this was due to some development, to some slowdown in development activity, particularly in areas where there's been considerable growth in development activity. But you can see that there's been a stabilization, and that the index actually grew in May by 1.1%. Unemployment claims are dropped a little bit. They're still higher than they were last year, but unemployment claims are still at historic lows. So and typically those are associated with some layoffs that have occurred with some older industries in other parts of the state. Building permits picked up 16%. Hours of work picked up 1%. One area that there's a little bit of concern is in the earnings category. There's some concern in earnings, but generally speaking, that's not a huge concern, but it is something that they are watching. The good news is, looking at 2020 and 2019, growth should be continued. John Connaughton, which is a faculty member at UNC Charlotte, does these analyses. Generally speaking, he anticipates North Carolina's growth in 2018 was around 3%, and he is projecting 2.5% growth for 2019. Anticipating the second quarter is going to come in around 2.2% here in North Carolina, and then we should have 2.7% growth for both the third and fourth quarters of 2019. A lot of that growth is going to be tied to the information sector. Some of it should also be tied to construction. Durable manufacturing is going to grow about he anticipates a 3.2% growth in durable manufacturing, as well as a 4.8% growth in business and professional services. From the standpoint of employment, the largest areas of growth that could still be in effect are construction, because there's anticipated construction in the second quarter, as well as in transportation, which of course is huge here in North Carolina, here in this area because of our role in logistics, as well as in leisure and hospitality services, things that we've talked about before. Looking at 2020, overall anticipating growth between 2.2 and 2.4% in 2020. Even though he does anticipate possibly with a lot of that being tied to construction and also to manufacturing. Anticipates about 2.5% growth in manufacturing, continued growth in logistics and wholesale trade, and about a 7.1% growth in information. Employment also should grow by 2.3% statewide in 2020. So we should continue to see employment statewide grow at about a rate between 1.5% and 2.5% year to year, which has been kind of the range that we've been going for the last several years. When we look at overall, the thing about this recovery, and this is true in North Carolina as it is in other parts of the country, is that this employment is growing primarily in major metropolitan areas. So Rocky Mount, which has seen 1.1% growth in our metropolitan area for April, compared to where it was last year, kind of puts us in that same range with a lot of other similar metropolitan areas: Greenville, Hickory, Jacksonville, Goldsboro, New Bern. Even Greensboro and High Point has kind of seen some drop off in employment growth recently. But if you look statewide, there's been 1.8% growth. When you take all the metropolitan areas together, they outperform that with 2% growth, particularly in places like Asheville and Wilmington and Charlotte and Raleigh, which have been kind of the drivers of economic growth here in North Carolina over the last decade. So now, what does this mean for us here locally? So we'll kind of drop off. We're really seeing where we are in Rocky Mount. The good news is we have seen some rebounding in employment. We did have a drop off in the fall of last year, late summer, fall of last year, but we have seen some growth in local employment. Now this is actually important. This does not necessarily mean that these are all this is only the jobs that are available. As we talked about, we do have a lot of vacancies, and a lot of that's addressing skill gap issues. Some of it also may be about compensation. But the reality is that we are seeing an improvement, and as you can see, compared to where we were in April of 2019, we have about 61,700 jobs. We were at about 61,000 in April of last year. So we are seeing employment growth this spring compared to where we were last spring. Where does that look? About 80% of our jobs are in the service sector, and about 20% of our jobs are in the goods production sector. That's in terms of non-farm payrolls of which total up around 56,000. Most of which, we actually have a high percentage of our jobs are private compared to a lot of other metropolitan areas. We are more reliant upon the private sector economy here in Rocky Mount than a lot of other areas are where they have larger public sector economies. But overall, we are continuing to see stability in the trade and logistics sector. The trade and logistics sector is really the largest, transportation and logistics sector is really our largest economic sector, and is of course a very important sector as we move forward with the expansion of CCX and other industries. We are really excited about the idea that we're going to see manufacturing pick up significantly with the developments that are ongoing with construction. That's going to lead to the establishment of these of additional jobs in the coming years. This information was actually provided by Alan Matthews recently, and this kind of is another indication that we have strong local business activity. One way that we have to do that is to look at reports that come in every month from the Department of Revenue about taxable sales. And this is retail activity, but also some industrial activity. And as you can see, in 2018, for the year, our metropolitan area grew by 5.1% in taxable sales, which is actually above the metropolitan area average. And then that growth has continued with another 5% in growth in 2019. So we have seen strong growth in those areas in just the last year. Our growth in that area is consistent with what we're seeing statewide, and in some cases is actually above that. Talk a little bit about real estate, and I want to thank Kathy Akers with Fathom Realty for providing this information. This is off of the regional MLS, but what you really see here is that we have had a booming real estate market here in the Rocky Mountain area. Overall, what these indicators show is that prices that we're seeing more listings, which is a good sign. We still have an inventory crunch. You talk to realtors here and they'll tell you they need inventory. That's what they really need, and hopefully we've got some projects coming online that are going to get them some new inventory here pretty soon. But the good news is that listings are up. We also have, if you look at that, through the month of May, we've had 303 listings, so listing activity inside the city should outpace listing activity last year. Same would be true with the metropolitan area. Listing prices have also gone up. You can see in May of 2018, listing prices and sales prices have gone up considerable. And that's an indication that we do have people coming in this market, not just buying homes at 120 to 150, but buying homes from 150 to 250,000. And you can get a lot more house here in this market for those prices than you can get in other markets. You talk to realtors, they are talking to people who live in the who work in the Triangle, maybe living in the Triangle right now. Simply put, inventory is not there in the Triangle area. They are now starting to look at Rocky Mount. Close commute, not that far away. Actually, it's faster to get here than it is within certain places within Wake County. So definitely some good signs here overall with respect to housing activity. I want to close with this new product that we developed, and this is the Rocky Mountain Area Business Conditions Survey. This will be a periodic evaluation of local business community. Certainly we'll do our best to kind of expand it to more people. We started with a group of around 30 local business owners and managers. It's an anonymous survey. I don't even know who submits to it, and I do that on purpose so that I'm not biased in any way in evaluating the information. It's evaluated in aggregate. It is inspired by similar surveys that are done by the Richmond Fed on a regional and state basis. And really what we're trying to do is to try to get an idea of where businesses are at the current, where they anticipate going in the next 6 months with respect to various characteristics of their business condition, including sales activity, employment, the cost of doing business, investment activity, their plans for investment, as well as the prices they may be charging for various goods and services. What I will say though, because I asked it as a question, is most of the respondents in this survey are service providers. So we don't really have a lot in the goods production area, and that's an area that I hope, in working with Caroline's Gateway Partnership, to try to address going forward. And the good news is, as you can see here, we have increases across the board. Overall, the responses were very strong in various areas, including in sales and revenue. Some strong indication that they are looking at trying to grow employment and raise wages. Production costs, they are seeing an increase in production costs. I sometimes imagine a lot of that has to go back towards labor cost, which does mean that they are seeing a change, that they are starting to look at increasing prices, which is not necessarily a bad thing. I would say a lot of businesses here have kind of had to hold the line on prices for the last several years, so I think many of them are happy to start being able to charge more and that there's a market to charge more for their products and services. We also see that there is a modest indication of growth in capital investment based on what the businesses are telling us, as well as strong improvements in customer growth. And really, I know for a lot of businesses here, in order to succeed going forward, because one of the biggest challenges, and we talk about this in Rocky Mountain Business Builders, and we talk about it with other groups, one of the biggest factors we have to concern with ourselves is growing customer bases and retaining customer bases. Because one thing we are starting to see is we are starting to see more competition from Raleigh-based businesses, from the Crescent, as David alludes to. That Crescent area is starting to see realizing, hey, there's a market here, And for our local businesses, and all the businesses that we surveyed also were all Rocky Mount-based businesses. That was a question we asked them. All of them have operations inside the city. That really is something that they really need to be focused on customer growth, because it's going to be a more competitive environment, which in many ways is a good way, but it's also something that businesses will have to respond to going forward. So to look forward, the good news is we got jobs, or as Joe Biden would say, J-O-B-S. 3,500 current and future jobs are looking to be here over the next 18 months, and I believe, based on some stuff, close to half of them are those that are currently available. Yes. Maybe a little less, but still, a lot of jobs currently available, and the key, of course, is connecting people with those jobs. Many of those jobs, hopefully, we can fill here with local residents looking for work, but that also means there's going to be a lot of people moving into the area, which is also a good sign. We need that positive inward migration. Nationally, we know that the housing market is in good place, but it is going to continue to struggle with the issue of affordability, and I think a lot of that's driven by supply. If we can try to do a better job of growing supply, I think that we'll be in good shape. And I think that that's going to be a key to the housing market here in Rocky Mount. We're in a position where we can grow supply. You've seen that if you drive on Halifax Road and you see the land that's being cleared at the corner of Halifax and Bethlehem. I believe that's a housing development. There was another announcement that was made that indicates there's some housing development going on in Edgecombe County here very soon. Overall, signs are moving in the right position, and they also indicate that Rocky Mount, North Carolina, based on the information we have, we're looking at a good 2019 moving forward, and we're looking at a good 2020. So that's a good sign for businesses here in our area that they need to continue to work to grow. They don't need to be too skeptical. Obviously, be careful, but don't be too skeptical about the economy, where the economy is headed, because it's looking like it's going in a great direction for our area in the coming couple of months. To close out, I just want to mention that we have another session in this same room next Wednesday, and this is on disaster preparedness. A representative from the Red Cross will be here to talk about their Ready Rating program. This will be a brief presentation, shouldn't take more than probably 30, 45 minutes. But for those of you who are business owners and are saying to yourself, how do I make sure that I'm prepared when natural disaster strikes? We're now in hurricane season, anything can happen. Certainly something we encourage you to come to as well, and we look forward to it. It will also be made available online. I hope this was a very informative presentation. Like I said before, we'll make sure the slide deck is available in case people want to be able to kind of read through it for themselves. But I thank you all very much. I hope some of y'all will be able to make it out next week. And
Ken, I want to thank you on behalf of the Chamber for an outstanding job.